Hey guys, are you looking to buy your first home in Australia but worry about the cost? Well, Fino has IQ, Australia's most followed mortgage broker on TikTok and also a home loan expert, and I'm here to guide you through the world of mortgage insurance. Now, before we dive into the pros and cons of using mortgage insurance to purchase a property, let me remind you to hit the subscribe button, hit the bell notification button just to stay tuned to more helpful tips and tricks that come your way every single week. So let's get started. So what is mortgage insurance in layman terms? So just imagine this, you're Iron Man and you're ready to buy your first home. But wait, the evil villain Thanos says you need to pay me a fee to protect your lender in case you can't pay your mortgage. That fee, guys, is called mortgage insurance. It's sort of like paying for a superhero sidekick to protect your lenders against the possibility that you will default on your home loan repayments. Kind of like Robin is to Batman or Samwise is to Frodo. But don't worry, you don't have to defeat Thanos to get mortgage insurance. Just like how Neo has to take the red pill to see the truth in the Matrix, you just need to pay a premium to the mortgage insurance company to protect your lender. And just like how Harry Potter had to defeat the evil Voldemort to save Hogwarts, mortgage insurance protects your lender from the evil of non-payment. And I know you got me, I'm using a lot of cheesy Gen Z references because I want to be relevant for guilty as charged. But look, mortgage insurance might seem like a bummer, but it's really like having a trusty sidekick or wizard's wand. Yes, I'm being cliche, but it is helpful for you to understand you need this to help with your home buying journey, especially you don't have 20% deposit. Now, firstly, let's discuss the pros of buying property using mortgage insurance. Pro number one, lower deposit required. One of the most significant advantages of using mortgage insurance is that you're allowed to purchase a property with a lower deposit. Typically, you'll need a minimum of deposit of 5 to 20% to buy a property, but with mortgage insurance, you only need 5% deposit. Pro number two is faster home buying process. Mortgage insurance can also speed up the home buying process as it enables you to get a home loan more quickly because you only have 5% deposit and you don't need to save up for the 20% deposit. And pro number three, not for you, but for the lender. It's a protection for the lender. Mortgage insurance provides security for the lender against the borrower, which is you defaulting on your loan repayments. And as a result, it can make it easier for you to get approved for a home loan because the lender is safely assured by the mortgage insurer that even if you default, they're protected. Now, let's look at the cons. The cons are, number one, higher costs. The primary disadvantage of using mortgage insurance is the additional cost. Mortgage insurance premiums can range from 0.2% to 4% of the loan amount, depending on the lender and the loan type. Cons number two is limited property options. Another drawback is that some lenders may only offer mortgage insurance for certain types of properties. For example, if the property is like high density, has a lot of units in one block, they can only reduce it to a maximum LVR of 90%. They can't go up to 95%. And con number three, longer repayment time. Lastly, mortgage insurance means that you have a large loan amount to repay back, which can result in a longer repayment period and ultimately higher interest repayments over the life of the loan. Okay, now that we've covered the pros and cons, let's talk about who the typical mortgage insurers are in Australia. The two major providers of mortgage insurance are Genworth and QBE Lenders Mortgage Insurance. The main difference between two companies lies in their market share and the services they offer. For example, Genworth is the larger of the two and has been operating in Australia for over 50 years. It has a larger market share and provides mortgage insurance for most major banks and lenders. On the other hand, QBE LMI is a relatively newer player in the market that has been operating in Australia since like 2011. While it has a smaller market share than Genworth, it provides a range of services beyond just mortgage insurance, for example, including underwriting, claims management, and risk assessment. But overall, to you, it doesn't matter. It's just mortgage insurance. So who cares really? Okay, calculation time. Let's look at an example of how much mortgage insurance you might have to pay on a $700,000 property with a 5% deposit and an interest rate of 5.5% over 30 years. Now, mortgage amount is $665,000, which is 95% of the property value. Mortgage insurance premium is roughly $23,617, which equates to 3.54% of the mortgage amount. And that makes the total loan amount to be $688,617. As you can see, the mortgage insurance premium adds additional cost of over $23,000 to the loan. And here's what the monthly repayments would be for a $700,000 property purchase with a 95% loan. So again, the loan amount is $700,000 times 95%, which is equal to $665,000. Interest rate is at 5.5%, and the loan term is 30 years. Using a mortgage repayment calculator, the monthly principal and interest repayments will be approximately $3,788 per month. So now let's talk about the First Home Guarantee Scheme, which is a program for first home buyers in Sydney that allows them to purchase a property without having to pay the mortgage insurance. To qualify qualify for the first home guarantee scheme, you need to meet the following criteria. Number 1, be a first home buyer purchasing a property in Sydney, having a maximum income of $125,000 per year for singles or $200,000 per year for couples. And number 3, be purchasing a property with a value of no more than $900,000. And number 4, having a deposit of at least 5% of the property value. By meeting these requirements, you'll be eligible to receive a guarantee from the New South Wales government, which can be used in place of mortgage insurance. And that's it for today, guys. In summary, here are 5 takeaways for the first home buyers about mortgage insurance. Number 1, mortgage insurance is a fee that is paid to protect the lender in case you default on your home loan repayments. Number 2, in Australia, the 2 major providers of mortgage insurance are Genworth and QBE Lenders Mortgage Insurance. Number 3 is mortgage insurance is typically required if you have a deposit of less than 20% of the property's value, but there are some exemptions if you're applying for the first home guarantee scheme in Sydney. And number 4, mortgage insurance can add to the overall cost of your home loan, but can also help you get into the property market faster. And lastly, number 5, it's important to compare the policies of different mortgage insurance providers and understand all the costs associated with the home loan buying process before you make an informed decision. So there you have it, guys. I hope you found this information helpful in navigating the world of mortgage insurance in Australia. Remember to hit that subscribe button, hit that bell notification button, because I'm going to release more videos like this every single week. And in the meantime, keep calm and mortgage on.